Hey team, whether you're studying for the CPA exam, you're an accounting student, or you're just in an accounting role, this simulation will really help you understand how we can take a company's unadjusted trial balance, get that inventory amount, and then book any adjusting journal entries for transactions or events around that cutoff date that impact inventory, and that will give us our adjusted inventory balance, right? So a great simulation, especially if you're studying for the CPA exam. Now, if you haven't yet subscribed to our YouTube channel, please do so. If you're studying for the CPA exam and you want to join our Facebook study groups, the links are in the description of this video. And then lastly, if you haven't yet tried the Universal platform, we're the only course that uses visual learning plus step-by-step explanation videos to help you fully understand the content tested on the CPA exam. So sign up for a free trial. Ask us about any discounts or promotions. And if you've already purchased another review course and it's not getting the job done, why keep trying what's not working, right? So ask us about the Spilt Milk program. Now, are we ready to get into this simulation? Because let's do it. So this simulation was focused on inventory adjustments. So what's the roadmap for this video? Well, we're going to start by going through an overview of the simulation, which focuses on really understanding those instructions, right? At the end of the day, the instructions are what we need to follow, so we do need to understand them in detail. And then I always recommend quickly reviewing the exhibits. We don't need to read these in detail, but if we flip through and have a general understanding of what's included in the exhibits, well, then as we go through and complete the simulation, we'll have an idea of what information we have and where to look for it, right? So we'll flip through those. And then once we're ready with that, we will actually go through and complete the simulation row by row. So let's go through the instructions like I mentioned. So basically we have Ionic Imports, and they are a luxury car manufacturer. Now they're preparing their financial statements for the year ending December 31, year 5. And it tells us that we're in the role of the accounting manager. Now, the next paragraph tells us that the CFO has asked us to review the exhibits and determine if we need to make any adjustments to the adjusted inventory balance. Right? If we remember from adjusting journal entries, well, we can get the unadjusted inventory balance from the company's trial balance. But then, as part of the close process, the company needs to understand any transactions or events that may result in adjustments to inventory, right? Those are adjusting journal entries. And once we factor those in, then we have the adjusted trial balance, which is then included in the final financial statements, right? So we're going to focus on reviewing those exhibits and determining if we need to record any adjusting journal entries to inventory. So this last paragraph, it tells us that in column A, this is the description or the nature of the adjustment, right? And this is where we'll have a little bit of an idea of where to look in the exhibits. And then in column B, we'll enter the adjustment. Now, if it's a positive adjustment, meaning it increases inventory, then we'll put a positive number. If it will decrease inventory, then we'll enter it as a negative number, right? So super important, but that's the whole idea of rolling forward this balance from the unadjusted balance to the adjusted balance. So now we can go through the exhibits. So the first one is the Ionic trial balance, and we can see that it's as of December 31, year 5, but it tells us it's unadjusted, right? And we're going to take the inventory balance, which has a debit balance of $2,850,000, right? So that's what we'll need from there. The next exhibit is inventory purchases. So the company purchases inventory from suppliers or vendors. And we'll have to look at the shipping terms because right around year end, there could be a cutoff issue, right? So that's one thing we'll need to focus on there. And then on the other side, we have inventory that's being shipped to customers, right? So this is inventory leaving the warehouse and going to our customers. And same thing there, we'll have to look at those shipping terms. Now, the next two exhibits relate to consigned inventory. So we have the company's consignment inventory policy. We'll reference that when we get to consignment. And then we also have an email from the consignee, which updates the company basically on, the amount of inventory they still have on hand, right? So those are two exhibits related to consignment. And then the last exhibit relates to the physical inventory count, right? So at the end of the year, on the last day, the company will go into their warehouse, count their inventory, determine what the value of that inventory is, and compare it to the perpetual inventory listing. And then any adjustments might need to be made to the inventory balance, right? So we'll get to that exhibit when we need it as well. So on the left-hand side is the simulation that we'll need to complete the rows for, right? So the first row we need to attack is the unadjusted inventory balance as of December 31, year 5. And remember the exhibit that had that unadjusted trial balance? Well, that's what we need to reference. And we can go in there and we see that inventory has an unadjusted balance of $2,850,000, right? So that's going to be the starting point for our roll forward. So in the simulation, we'll enter $2,850,000 and it's positive. So the next row relates to inventory purchases, right? So this is inventory the company has purchased from suppliers or vendor. So we'll bring up the exhibit called inventory purchases. And so as we can see in there, it basically lists out the inventory that the company purchased in the last few days of the year, right? From December 28th to December 31st. Now, when we think about the shipping terms for orders, well, we have FOB destination or FOB shipping point. Now, none of these orders have actually arrived to the company's warehouse as of the end of the year, right? So we know they're all in transit. Now, for inventory purposes, the company would exclude any inventory that has shipping terms FOB destination because title does not transfer until it's received by the company. However, when it's FOB shipping point, for Ionic, they would take title when it leaves the vendor's warehouse, right? And we can see that there's one shipment that has terms FOB shipping point, and that's for $122,200. Right, so when that inventory left on December 29th, year 5, it became the inventory of Ionic, even though they haven't received it yet. So we will need to record an adjusting entry to increase inventory for that amount. So as we can see in the adjusting journal entry, since we need to increase inventory, we'll debit inventory for $122,200, and then we'll credit accounts payable for $122,200. Now, all we care about is the impact of inventory for the simulation, but that's the full journal entry. So in our simulation, because we're increasing inventory, we would put a positive $122,200. So the next row relates to customer orders, right? So our customers have ordered this stuff, and we have the detail from this exhibit for the last 2 days of the year. So it tells us that none of these orders have arrived to the customer yet. So this is the opposite when it comes to shipping terms. If it's FOB destination, well, it remains in inventory until it arrives to the customer. However, if it's FOB shipping point, then inventory becomes the title of the customer when it leaves our warehouse. Now, in the simulation, it says that all of the inventory has been removed from the system. So we know that that's correct for FOB shipping point, but for FOB destination, well, we still hold title to that inventory and it should remain on our balance sheet. So the two customers that have FOB destination are going to be LA dealers and electric dealers. Now, the other thing we need to recognize is that those invoice amounts, that's for the sale price and not necessarily the cost of the inventory. And the exhibit does tell us the inventory is sold at a 25% markup. So what we can do is perform a quick calculation to determine the cost of that inventory. So if the total invoices for those two customers totaled to $88,000, and that's the revenue and accounts receivable amount, well, if we divide by 125%, which basically includes that a 25% markup, then we can get into the cost of the inventory, right? So the cost of the inventory is going to be $70,400, and that's what we need to know for our adjusting journal entry. So as we can see in our adjusting journal entry, well, if we need to remove revenue and the accounts receivable, we would debit revenue for that $88,000 and credit accounts receivable for $88,000, right? Because we can't recognize that sale yet since basically it's FOB destination and the inventory has not arrived to that customer yet. right? So then when we think about the inventory, well, we need to add that back to our balance sheet. So that's why it's a debit to inventory for $70,400. And then we would credit cost of goods sold to remove the cost of goods sold for that same amount. Right, so what's the impact to inventory? Well, we have to add it back for the inventory that is still ours, right? So it's going to be a positive $70,400 in our roll forward here. So the next row relates to consigned inventory, right? So let's bring up the email from the consignee. And it says that basically they received $750,000 worth of inventory on a consignment basis on December 15th of year 5. Now that amount reflects a 25% markup. So just like the customer orders, we're going to have to remove that markup to figure out the cost of the inventory. Now the one thing we don't know is, did Ionic Imports properly account for consigned inventory? Because what we know under US GAAP is that even though it's not in their possession, because it's on a consignment basis, then Ionic would still include that inventory on their balance sheet. So what we can do is bring up the consigned inventory policy to determine what is their policy. And it says that they follow US GAAP and that any consigned inventory remains on their balance sheet until it's sold by the consignee. Now it also tells us about that 25% markup, and then it also says that they receive updates from the consignee at the end of the period. So if we go back to that email from the consignee, it says that they basically still have $300,400 of consigned inventory in their showroom, right? So they did sell some, and we need to record an adjusting journal entry for the consigned inventory that was sold. So we're going to need to calculate how much revenue and inventory was actually sold. Right, so what we can do is take the consigned inventory that was transferred, which totaled $750,000. And then from the email, right, it said that they still have $300,400 on hand. So that means they sold consigned inventory of $449,600. Now that's the revenue related to that sale and not necessarily the cost for that inventory, right? So if we remove the markup by dividing by 125%, then we get to the cost of inventory, which is $359,680. So the adjusting journal entry, well, to record the actual revenue and accounts receivable, we would debit accounts receivable for $449,600 and then credit revenue for the same amount. Now, since the inventory was sold, we need to remove that consigned inventory from our balance sheet, which is why we have the credits inventory for the cost of that inventory, which is $359,680, and then we also need to record the cost of goods sold for the same amount. Now, what's the impact of inventory? Well, because we're crediting inventory, inventory is going to be reduced, so it's going to be a negative $359,680 in our roll forward for the simulation, right? So that's what we would enter. So the last potential adjustment relates to the results of the physical inventory count. All right, so we'll pull up the email, which happens to be from the audit manager, and they say, okay, we were up way too late last night, but here are the results. Now they identified 3 variances. However, they weren't able to resolve the variances for both tires and brakes, but they could not resolve the variance for gears. Right, so they will need to record an adjustment to inventory for that amount. Now, since the physical count was lower than the perpetual listing, that means they need to decrease inventory by that $57,500. Well, since inventory is overstated and we need to reduce inventory, we would credit inventory for that $57,500, and then we would record additional cost of goods sold for the same amount. Now, because inventory is being reduced in our simulation, we would enter negative $57,500 for this physical inventory count. So now we've gone through each of the potential for adjustments and recorded the impact to the inventory balance. So now we can get the final adjusted inventory balance, which basically just means we need to start with that unadjusted inventory balance of $2,850,000. And then we increased or decreased inventory for our adjusting journal entries, and that gets us to the adjusted inventory balance of $2,625,420, right? So that's the final trial balance amount that would be included in the company's financial statements. So that was a great simulation because we had to really focus on, okay, what are all the potential reasons a company would need to adjust their inventory balance at the end of the year, right? We talked about inventory purchased, customer orders, and we really had to focus on the shipping terms. We talked about consigned inventory, and then we also talked about that physical inventory count, which most companies do on the last day of the year, right? So those are 4 key areas that we need to understand that could impact the company's inventory balance. So great simulation, and really focus on making sure you understand this in detail.